This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only.
Welcome back, Diana.
Hey, me.
So 2 weeks ago, I was sitting here celebrating new record highs across multiple markets. And today, I feel like we should be celebrating again because every single market I have been looking at is hovering around record high. So the ASX 200 has returned about 7% year to date. That's actually quite remarkable despite all the volatility that we had. And despite a pretty bad jobs data that we received last week, we've had a new rise, a new cycle high in unemployment rate in Australia. But yet everyone's still celebrating, earnings seem still okay, and markets are roaring. Why do you think that is?
Well, it's been interesting that there's been a bit of a rotation in the Australian share market between lower growth in the financial services sector, mainly the banks. And I mean, that was after they reached very high levels, especially shares like CBA. And that's been replaced by this rebound in mining stocks. So there does seem to be a bit of a rotation play here. But overall, even when you're sort of taking that out, I mean, the resilience of shares is very surprising. But at the same time, earnings growth is still holding up despite downside risks to growth and signs of new higher unemployment. At the same time, that data print, I suppose, just confirmed that the RBA probably should have cut at the last meeting in July and that they probably will cut in August. I mean, I never say never, given what happened at the last meeting. But when the market prices in a higher chance of lower interest rates, we do normally tend to see shares benefiting from that.
Yeah, I do agree. So let's unpack that unemployment market data a little bit, because it actually came as a bit of a surprise even to us as well. We were forecasting a 4.2% unemployment rate.
This is for the June figures?
This is for the June figure. The RBA was also expecting something around 4.2. It reached 4.3. Some people might be asking us why the fuss about a 0.1% difference in forecasted unemployment rate. But the thing with that jobs market data was that a lot of other indicators have weakened over the last year as well. So over the last 12 months, we've seen roughly less than 2% growth in employment growth, about 1.8% rise in hours worked in the economy. So both of them have lagged the growth in the labor force. That's running at around 2.3% year over year. We've also seen a bit of a weakening in underutilization rates, so that accounts for people who want to work more hours but can't find more hours. We've also seen a bit of a rise in the percentage of unemployed people due to job losses rather than job quits. And while our favorite charts is counting the number of job ads on sites such as Seek or any internet sites really. So that number as a percentage of the labor force has weakened as well. So it seems to be a rather broad-based weakening in the labor market rather than just an abnormality in the unemployment rate data.
But I wouldn't say the labour market's weak. It's just weakened from very tight levels. I mean, basically we saw the tightest part of the labour market in 2022. And when we say tight, we basically just mean that the unemployment rate's very low, that it's easy for people to get a new job. So we saw a lot of job switches at that time, wages growth went up. And the concern with a tight labour market is that it generates wage pressures and wage inflation. But we're actually seeing wages growth slow, although it is still running above 3% on an annual basis. So perhaps that's why the Reserve Bank is still thinking that their characterisation of the labour market is that it is still tight. And I think where we fundamentally differ with the Reserve Bank is that we think that the full level of employment, or what economists call the NAIRU, the non-accelerating inflationary rate of unemployment, bit of a mouthful, that full level of employment is an unemployment rate sub 4%, whereas the Reserve Bank think that that full level of employment is somewhere at 4.5%. And again, it doesn't sound like a big difference, but it sort of changes how you think about the dynamics of how the unemployment rate and changes in the labour market will impact inflation. So I think that there will be pressure on them to cut rates in August, but it obviously does depend on the inflation data that comes out for the June quarter. And there are a few funny things going on in the labour force too, I think. The job ads that you mentioned, I do feel like they are going to be higher for longer after the pandemic. And the reason I say that is because in my eyes, there has been a structural change to the labour market. We've seen a big increase to what we call the non-market, so the non-market part of the economy, so basic public sector jobs and public sector related areas, so areas that receive a lot of funding from the public sector. And I think that has led to a structurally lower level of the neighbourhood, or a lower level of full employment. And there also seems to be a high level of job vacancies because it's easier for employers to advertise on online websites. And we were talking about this morning, that you said that people might actually find it easier to find work. We now have a record level of multiple job holders. People can start their own startup or their own online business with little barriers to entry, which is potentially keeping the level of job ads at a high level. So I'm not convinced that job ads are really showing us an accurate picture of what's going to happen in the labour market from here.
I guess in terms of job ads, it's actually quite interesting. And we've seen this in the data as well, that a lot of the job vacancies have been concentrated in certain areas, such as healthcare or social assistance. And I feel like those are definitely going to remain quite elevated in the future, in probably even the next 10, 20 years, because Australia has an aging population, and that's just not going to go away. Another interesting part of that job vacancies data I find is from the construction industry. So it seems to be that Australia has a massive shortage in tradies. If you've done renovations in the past 1-2 years, you probably know about this.
And the cost of the renovations have also gone up by about 40% in the last 4 years.
Yeah, so that has actually made the RBA quite worried about inflation as well, because we've had a shortage of labor in the construction industry that has pushed up new dwelling costs that makes up a pretty substantial part of housing inflation, which has been one of the major drivers of sticky inflation in Australia over the past few years. It's also quite interesting that, so a few months ago, I did this report on the economics of immigration in Australia. And while on the surface, additional immigration should not really be a net positive or net negative to the labor market, because they add both to the supply and demand of labor.
Yeah.
You know, there are more workers coming in, but there's also more demand for workers. So that shouldn't yield a negative outcome. But the construction industry is a separate issue. So only about 2.8% of new migrants into Australia over the past 10 years work in construction. That percentage in the native population is closer to 9%. So basically, that has added to even more shortage in the construction industry. And I feel like, again, that issue is just not going to be solved in the near future. We're just still going to have pretty elevated inflation in new dwelling costs and new dwelling purchases over the next coming years. I guess the question is, that's an issue within the construction industry, but is it going to spill over to other industries? Should the RBA worry so much about these spillover effects of tight labor market in terms of inflation? I'm actually not sure, because there's still a lot of other things that are going down in terms of prices.
Well, when we ran through the numbers on the monthly CPI and tried to do our forecast for the June quarter figures, we're getting a quarterly increase in the trim mean of about 0.6%. I think that should be enough for the Reserve Bank to be comfortable cutting interest rates again at the August meeting. That would annualise at a rate sub 3%, and they're targeting 2 to 3% inflation. But time will tell on that. And I've sort of enjoyed the lack of trade news coming from the US this week. We've only seen trade deals between the US, Indonesia, Philippines, and Japan.
It's funny that you say that it's quiet, because in, a normal year, 3 trade deals in the span of 5 days is actually quite a lot of news.
I know, but given where we've been, where it's been updating our tariff chart every single day.
Every single hour, actually.
And just this constant news flow from Trump's Truth Social account, it gets quite tiring.
So with the latest on trade deals, they are not too bad, not too great, I would say. So we've had 19% tariff rates on both Indonesian and Filipino goods coming into the US.
That's still worse than the Liberation Day levels?
Yeah, but that's lower than the 20% that Trump threatened the Philippines in his letters like 2 weeks ago. So that's a 1 percentage point difference.
Yeah.
So it's a bit lower.
I mean, Trump's going to claim victory here, and I guess investors are just thinking, well, it's not as bad as feared, or it's not as bad as it could potentially be. US tariff rates will settle somewhere between 15 and 20%. That's obviously still multiples above where it was before Trump started. So it is still going to place upwards pressure on inflation. And there has been a big question mark as to who pays the tariff, right? You know, Trump and his team say the foreign country pays the tariff. As economists, we would say that's absolutely not true. That's not how tariffs work. The tariff is borne by the importer, who can then pass it down. The importer is the of the importing country, so the US importer will pay it. And there were some second quarter earnings this week from General Motors, and they said that they're taking about a 1.1 billion hit to their margin because of tariffs. So they're obviously a major importer and exporter of cars in the US, a major producer, and the tariff rates are going to hit them. So I think that that gives us some sign that it is going to be US-based companies who are going to be paying some of these tariffs. And then as well as that, of course, that will get passed down to the consumer.
And you can see early signs of US companies paying it through foreign countries' PPI. So that's the producer price index for major producers, especially in East Asia. So China, Korea, Taiwan. Those PPIs haven't actually increased that much over the past few months. So it seems like they haven't really absorbed that tariff cost. Yeah. So someone's paying it in the US.
And we also saw the impacts to the consumer in the latest June consumer figures for the US. And we could see it in toys,
windows and curtains and floorings and furnishings. So most of the imported stuff into the US.
It's just going to get worse from here in the next few months, I think, because we've only started to see the impact of those high tariffs. So I understand why the Fed wants to proceed cautiously from here. I mean, the US economy is not collapsing, so there's no need for a near-term rate cut. And obviously, they'd be a little bit concerned that inflation is going to spike up in the short term.
Going back to the trade deals, I think the deal with Japan that's just recently announced is actually a little bit more positive than that. So Donald Trump set the tariff rates for Japanese goods at 15% instead of the 25% that he previously threatened. And that's also lower than the 25% that's being applied to all car imports into the US. So that's the major product that Japan exports to the US. That's a good sign for future trade deals to come. And Japan is also one of the first countries that try to negotiate with the US as well. And after 3 months, it seems like they have finally reached a deal.
I guess that is a good sign because we know of some of the historical tensions between Japan and the US around trade. And I saw that Trump posted in his Truth Social account that Japan's going to allow more imports of US rice.
So for context, Japanese people eat a lot of rice. Every year they consume about 8 million tons of rice. About 300,000 tons are actually imported from the US. And they're actually...
That's a fraction.
Yeah, it's a small fraction. And they're actually kind of forced to import from the US under the WTO terms as well. So every year they have to import a minimum amount of rice.
So why does that happen? Why does the WTO set that?
To encourage free trade, because Japan actually has really high tariffs on rice. And that's not just on US rice coming into Japan, that's also on Korean rice or Taiwanese rice as well. I guess with Japan, there's a bit of a national security issue here. They pride themselves on producing the best quality of rice, so they always perceive foreign rice as inferior to the short grain Japanese rice. And the Farmers Association also has a massive power in terms of politics as well. It's a bit similar to the unions in a lot of other countries.
The price of rice has been skyrocketing lately. What's been going on?
So in Japan, in the Japanese inflation rates in rice has reached 100% over the last 12 months.
So has this been our sushi prices going to go up?
So it's spilled over into some other categories. So that's including mochi. So that's Japanese rice cake. That's 10.7% over the last year.
My son's going to be devastated. He loves those things.
And sushi as well, yes. And that's quite interesting because Japan has always been known as this low inflation country for so long. But now their inflation seems to be settling around 3%, above 3% even.
Is there a supply issue with rice or what's been happening?
There has been a bit of a supply issue, but I think a lot of that supply issue comes down not just to the production of it, but also to the supply chain issues. And also comes out from the fact that the Japanese farmers really want to put up protectionist policies. So coming up, all these trade deals, maybe it's actually a good sign that they're trying to open up the countries a little bit more to free trade, to Californian rice that also California also produces pretty good quality low short grain rice for Japan as well. So again, I think that's actually a positive side for global trade.
Well, my favorite news story of the week, sort of going on to the food theme, was that Trump has been pressuring Coca-Cola to go back to the old recipe of Coca-Cola and make it using using American cane sugar rather than the high fructose corn syrup that's currently in Coca-Cola. And I didn't know this, but we looked this up before the podcast, and Australia produces Coca-Cola using Australian cane sugar too, and a lot of other countries do as well. And Canada and the US are sort of the exception here. So I don't know if that's part of the making America healthy again. I'd probably think not. But that was just something funny that I came across this week. We also didn't mention the RBA minutes that came out this week following the shock July decision to hold rates rather than to cut rates as the market and most economists were expecting. Did you think it provided any new colour on what the RBA was thinking at the time?
Well, not much. So in the minutes, the RBA provided, I would say, three main reasons for holding rather than cutting. The first one is that they would want to lower rates in a gradual and cautious manner. They've already done 2 rate cuts this year, so I think in their opinion, 1 cut per quarter seems prudent rather than...
They still seem so obsessed with inflation, and I sort of understand when you look at broader inflationary measures like the deflators in the GDP, unit labour costs, although that accounts for productivity. But the inflation that people pay at the shops, headline CPI, you don't even really pay the trim mean. That's a statistical economist measure. Headline CPI is at the bottom end of the 2-3% target band. Yes, there's some things going on there with electricity rebates, but when you look at the experience of other countries that have cut rates, they haven't seen an inflation rebound. So I sort of think the RBA needs to be a bit less obsessed with inflation.
I think it's more of the story of the RBA being quite confident in their forecast. So the reason why they pay attention to the trimmed mean is that they forecast technically the headline CPI, the headline inflation rate, would revert to the trimmed mean measure rather than the other way around. And the trimmed mean measure, in their opinion, on the quarterly reading is at 2.9%. That's still too high for their liking because they would like something closer to 2.5%. And another thing that's related to that is that they still think that there's a productivity issue in Australia. The price you pay for labor in Australia is still too high in certain areas, and that basically pushes up inflation in those certain areas, construction, for example. So they do think that inflation still has these upward pressures in it, and it might actually go back up again, and they really don't want to risk that. They just want to be cautious, using their own words. I don't know if they're being overly cautious here because, to be honest, they should be cautious on the other side of the equation as well. They have a dual mandate, and the other one is growth. And we've been growing quite poorly as a country in Australia.
And to counter that, then they would say, well, on their estimates, maybe Australia's potential rate of growth is, just over 2%, because if we have population growth, that's going to slow maybe to 1.2% or so, or even 1%, and then we have this big weakness in productivity growth. I mean, we've basically had zero growth in productivity in the past 12 months, and then in the past few years as well. Well, maybe trend growth is only at 2%, so at 1.5% GDP, we're not running too far away from trend growth. And maybe that's why they're not too worried about the growth figures like we were. But nevertheless, we do think that we're going to get another 4 rate cuts in this cycle, so with the cash rate ending at 2.85%. Which my mortgage would approve of.
I was going to say that. Yeah, I do agree with you. I think even with trend growth just above 2%, we as a country are only growing at 1.3%. So that's still quite low even for the RBA. So yes, please, the RBA, can we have some more rate cuts coming up?
Hopefully they listen to this podcast.
Yep.
Thanks, me, and see you next time.
Thanks, Diana.
For more info on Shane and Diana's podcasts and reports, head to the Insights Hub at amp.com.au.